I want is the most massive round of applause for Mr. Ranjan Bhattacharya.
What are we going to do tonight? We're going to join the dots. I mean, recession can sound a bit gloomy, but it's not gloomy, it's opportunity. You know, everyone who has been successful through a recession will tell you their best deals were done at that time. But it's about understanding what is happening, why the recession is actually happening, and what opportunity is that bringing about. And that's what I'm going to help you guys do by joining some of the dots. Now, we've had a lot happening, really. This whole Liz Truss and kamikaze Kwarteng and all of that, the disaster budget. What basically happened is the UK essentially has a national credit card. And they went along and said, we want to max out this credit card, but we're going to offer no plan for how we're going to pay the minimum monthly balance installment, and no plan for how we're going to pay back any of the capital. So that's why the lenders got a bit spooked. That's basically what happened. You know, the problem, a lot of people go around saying that, well, why are we so bothered about the markets? You know, who are these people in the city, these market traders dictating what we ought to do? Well, they have a right to dictate what we ought to do, because Britain as a country is not making in tax receipts what it's spending. So it is running a deficit. So if you are spending more than you're earning and you're asking for a loan to sub the difference, then obviously your lender has a say. If you're running a surplus budget, then do whatever you like in government. Markets don't really mind. You do what you want with the money. Give away to whatever causes you like, spend it on what you like. But when you're running a deficit and you want a lender to plug the hole of that deficit, then you have got to listen to what that lender has to say. It's the same for an individual, it's the same for a company, it's the same for a country. And what happened with the budget is that out of nowhere, I mean, we already had a massive spending sort of commitment, and the spending commitments that were announced in the budget of kamikaze Kwarteng kind of took this to massive levels, basically. And with no plan, with no OBR scrutiny, with no plan for how it's going to be paid back, the markets got completely spooked. That's essentially what happens. Now, Britain is in a unique club of countries in that Britain can't go bust. It'll take a huge amount. No, Britain will never go bust. And the reason why is that Britain actually, when it makes its debt, it owes its debt in pounds. So if we want to borrow, we borrow in our own currency. You know, earlier this year, there have been huge problems with Sri Lanka. If people have been following that, and there are a lot of countries which are teetering on the edge. And that's because in Sri Lanka, of course, they can't issue debt in their own currency. Their debt is all in dollars. So if they have an issue where they can't meet their commitments, and they can't find US dollars, then they're stuffed. Britain is in a small club of countries that can say, well, okay, we don't have the money, so we can literally print it. But printing it has a political cost, because what that means is that people don't have confidence in the economy and the way it's run, and the currency becomes worth less, which means imports cost you more, which means because there's more currency, when there's more of anything, it's not valued so much. So you get inflation. You know? So when they can't kind of pay their way and they print money, it causes other problems. What happened during COVID was rather unique, because all the central banks got together and did a bit of money printing all together. So relative to everyone else, everyone was printing money. So if we're all inflating at the same time to pay for COVID, it's all kind of okay. What's been happening, though, is since the beginning of the year, the US has been doing quantitative tightening. They've been rolling back on all of this. And we've been saying, hey, we're going to print some more. You know, the magic money tree that they were always accusing Jeremy Corbyn of was something that was found by Kamikaze Kwarteng, basically. And he really used this magic money tree, and no one really had faith in what he was doing. So there was no plan to plug this deficit, and the markets lost confidence. So when the government borrows by issuing government bonds. And someone has to buy those government bonds. And the main buyer of government bonds is UK pension funds. Now, if UK pension funds suddenly got a little bit spooked, because they've got to look after the pensioners as well that they represent. So what they said was, look, it's not as though we don't want to lend to you, but we don't really think the figures add up, and we have got to price in a little bit more of a premium for the increased risk of UK government debt. And that's why interest rates on government debt started to rise, which caused this massive spike that we saw in recent weeks. And of course, there was printing so much money that there wasn't really the buyers to buy them. So the Bank of England, I mean, again, we're in a unique club of countries that have these lovely little facilities to dealing with these problems. In the Bank of England, we have something basically called the TECRF, which is the Temporary Expanded Collateral Repo Facility, which basically means that if no one wants to buy government bonds, the Bank of England will print money and buy them themselves. I don't exactly know how that works, but that is exactly what's going on. No one wants to buy the goddamn bonds, so let's just one arm of the government print them and they'll buy them. The Federal Reserve has the same sort of facility. They call it the Money Market Mutual Fund Liquidity Facility, which is actually pronounced MILF. You can't make this stuff up, really. So when they have a crisis with selling their federal government debt, treasury gilts and all of that, they invoke the MILF and print the money to buy the bonds. You know, not many countries can do that. So in the Kamikaze era, 65 billion was just printed out of nowhere to buy these government bonds. Yields went up. And this 65 billion, when all the other countries are kind of doing quantitative tightening, doesn't really work that well. Because what it means is there's more money around, and that's going to lead to inflation. We saw a drop in the pound and all the rest of it. What we were seeing anyway at the beginning of the year was an upward movement in interest rates. What we saw under Kamikaze Kwarteng was that it was going to be far higher than it would have been. Now, what we have seen since the grown-ups have taken back number 10 again and number 11, the markets have a little bit more confidence that there's going to be a bit of fiscal discipline. We're going to manage the credit card a little bit better, have a plan for paying the minimum monthly installment every month, and so forth. And what we have seen is that just in recent days, we've seen the pound and interest rates on government bonds return to what they were before Liz Truss came in. We've also seen in the last couple of days, because during the Liz Truss era, many buy-to-let mortgage products were actually withdrawn from the market. Some of them are starting to come back now, and the rates are lower than what they were under the Liz Truss era. And that reflects the fact that the long-term money, the money markets, are not pricing in money as high anymore as they were during that era. So that is good news that it's stabilizing a little bit. But the problem is that interest rates were going up anyway. Even if, forget about the Liz Truss era. I mean, I think that's basically a bad dream. You know, if you ever watched Dallas in the 1980s, this is the whole series where Bobby Ewing came in the shower, and it was all a dream of Pam, and the entire series was forgotten about. So just forget about the whole Liz Truss era in that same vogue, because we've basically rolled back to pre that time. But interest rates were going up, and that has an effect. That has an effect, in particularly, on commercial property. Now, that's fundamentally because, and I've been talking about this for some time, Goldman Sachs have put out a report saying that they expect commercial property buy-to-let properties will fall by 15 to 20% over the next couple of years. Now, why is that? Well, commercial properties aren't valued the same as residential properties. They're valued on a yield basis. They're not valued on a bricks and mortar basis. They're valued depending on the income that you generate from those properties. So if I can get 3, 4, 5% on a bond and absolutely do nothing, then I would expect a premium on that if I'm going to buy a commercial property as a buy-to-let investment. So when interest rates rise, then there is a risk premium attached to buying property. People expect a generally 1 to 2%, a 2% spread, if you like, over doing something simple like just buying a bond. Does that make sense to people? So when the yield expectation increases on commercial property, then the price falls a little bit. And that's what's driving all of this at the moment. So the main triggers that are going to be causing a little bit of a sell-off in commercial property is two things. First of all, the pension funds. I mentioned the pension funds at the beginning. The pension funds have a massive liquidity issue, which is why they couldn't buy the bonds and the Bank of England had to step in. So they have to liquidize some of their portfolio. Pension funds tend to own government bonds and also own commercial property. So they've already started disposing of some of their commercial property assets. As interest rates go up, we're going to see people who have trouble refinancing commercial assets. Commercial loans on commercial buy-to-lets are often for 5 or 7 year terms. So if you're refinancing a facility and the rate is higher and the yield is higher, then the valuations will be slightly lower, which will cause certain people certain problems and they'll want to sell off. So those are the main two reasons why a lot of commercial property stock is coming on the market right now. And again, I've been talking about this for a few months now, and this is actually being reported on, it's happening right now. We're seeing that commercial valuations are falling a little bit for all the reasons that I've talked about. When you get higher bond yields, you have to have higher commercial property yields. Commercial property yields will be 2 to 3% higher than what a bond yield will be. And that's why last month we saw commercial property values fall by 2.6%. You only see that when there's a massive upward tick in the cost of interest rate and bond yields. And that's exactly what's happened just recently. And this quote from the article really sums it up. Why would anyone bother buying commercial property if gilts remain above 5%? You know, you've got to have a premium above government gilts for your commercial property investment. So this is causing a bit of a tumble in the valuations. And what we are seeing is these pension funds disposing of these commercial assets. They're disposing of them left, right, and center right now, mainly because of the liquidity crisis, but also because the yields that they're producing are not quite right for the income they need to generate for their pensioners. That's the main issue. The other issue with commercial property, of course, we've got a recession. Recessions affect businesses. Businesses occupy commercial property. So there's less demand for commercial real estate space. So what's happened also is that the a lot of pension funds invest in commercial property directly through large buildings, but they also invest in property funds which are quoted on the stock exchange. Now, those property funds have recently suspended withdrawals because there are too many people withdrawing money out of those funds. So what those property funds are having to dispose of their commercial assets to liquidate so that they can meet the cash calls that they're getting on their funds. So there's a lot happening in the commercial property space. Throw in the curveball of the EPC. By 2023, all commercial properties will need to achieve EPC grade C, So if your property is becoming vacant and you're a commercial property landlord, you have to think, well, is it really worth revitalizing my building to meet the EPC requirements, to spend all that money when there may not be commercial demand? Should I be doing something else with that building altogether? Just today, I got an email from Allsop, the UK's largest commercial auctioneers, for their sale on 1st of November. And there were more than 18 guide price reductions. The sale is on the 1st of November, and they have announced 18 guide price reductions. What that basically means is they've been marketing the thing for the last 4 weeks. There hasn't been the interest in a number of these commercial property lots. So they've said to kind of stoke up a bit more interest, they have reduced the guide prices. And they've quoted yields which are far higher. They've quoted yields on guide of 8.2, 7.8. Just a year ago, those yields would be about 6. So that's what's kind of going on. So these signs are actively playing out right now. Where does that leave us then? Well, we've got rising interest rates. They're still going to rise a little bit. But then there's a lot of talk of them not rising that much. You know, it's not going to be the 7-8% that we feared just a few weeks ago. So that will mean you're going to have higher yields from commercial property, which means the values will be lower. I've just more or less run out of time. So what I'm going to do is I'm going to go to my other slide, which I want to kind of focus on here, which is the way commercial property is valued. Commercial property is purely valued based on a yield basis. So it's the income that it produces. And people will expect a higher yield if they can get a higher yield. If they can get 4 or 5% on a bond, they'll expect more than that from a commercial property. Residential property is not valued like that. Residential property is valued independently of the rental income it produces. It's valued based on location, and the desirability of the property and how it compares to others in that vicinity. So residential property is valued differently. This is the first recession ever where, during the last recession in 2007, 2008, there was I did quite a few commercial to residential conversions, but they were under full planning permission. We had no permitted development rights at that time. So in a recession, you had vacant commercial buildings, but you had to purchase them or get them on a lease option or something like that, apply for full planning permission, which was a bit vague sometimes and certainly not certain, and then convert them to residential use. With this recession, this is the first recession where we have permitted development rights. Michael Govey is back at the levelling up place. He loves permitted development. When councils are saying they want to have Article 4s and exempt them from it, he's really slapping them down and saying, no, this permitted development has to happen. Because the government knows that with a recession, they want growth. And a massive way of engineering growth is to get the property sector moving, and particularly building activity, because it creates a lot of work in the wider economy. And permitted development is where you take an existing building, the foundations, walls, windows, roof is all there, and you're just converting it to residential use. So it's internal reconfiguration. So it's much quicker to bring on 10 flats onto the housing market than it is to build 10 houses in a field. So it's very, very quick. So the government are firmly behind the permitted development rights that exist. And this offers a kind of unique opportunity at the moment, because vacant commercial property is worth even less than tenanted commercial property. So we're going to see massive falls in commercial property. We're going to see lots of distressed sales, particularly as we come into January. And it's the opportunity is for the savvy investor to say, well, okay, I can pick up this property for this many pounds per square foot. I can use my permitted development rights to convert these spaces into residential use. And you can just basically rent them out. The rental market is going gangbusters right now. The most optimum strategy that I'm recommending these days is to convert with a view to letting these units out and then refinancing the whole building on a long-term commercial mortgage. So what we are seeing, we will see a plateauing of residential prices. We will see slight falls in certain areas, but you will see much deeper falls because of the interest rate issue and the yield issue in commercial property. Commercial property will always fall much further. So this is the only recession ever where there's this clear path with permitted development to convert these into residential use. So what do I recommend people do? I recommend people go into these deals and look for 40% margin. Look for 40% different after you buy the property, you've got all your costs, your development costs, and all of that, and you're looking at the end values. Look for 40% margin. Make creative offers. Now, increasingly, vendors are taking quite a lot of time to sell commercial units. There are deals to be had by doing things like delayed completions, option agreements, lease option agreements, if you know what type of vendors and what type of properties are receptive to those sort of offers. I'd recommend that you only look at permitted development. Don't bother with planning permission, it's too vague, it's too uncertain. You want certainty. You want to take buildings where you can convert them to residential use under permitted development rights, which means it's quick, in and out, refinance, and do as many as you can in this recessionary period. And I recommend your exit is through rental. Do good quality accommodation which meets the rental demand that's out there. And exit by refinancing. So when you finish the project, you get the whole property valued on a commercial mortgage and you refinance. And if you do the margins right, you should be able to come out with little or none of your money left in. These are the types of ways that we're structuring these deals at the moment. The objective of the game is to produce positive cash flow. And if you actually do 40% margin, you can actually come out of a deal with little or none of your money left in the deal at the end. And if you're producing positive cash flow, that is a near infinite return on your investment. And that's what you've got to consider. Because when real inflation is 18%, you've got to be doing something with your money that gets you bigger return than 18%. Otherwise, you're losing money year on year. And this is the strategy that really delivers that objective. It's not just about hedging against inflation, which is robbing you all, but it's actually getting ahead. And that's basically how people do it in a recession. You've got to know how to find distressed assets. You've got to be able to figure out what you can do with them to add a ton of value. You've got to be able to try to negotiate these deals and structure the purchase of these deals in a creative way, because there aren't many buyers in town. When there aren't many buyers, the sellers are all ears if you've got a creative way of structuring the deal, which allows you to put in little money in. So what we try to do is say, put in a little bit of money to secure the project, and if they don't need the money up front, pay them out later on when you refinance at the end of the project. It's that sort of structure that we're talking about. Rinse and repeat this. The more times you do this during this recession, the more fun you're going to have, and the more wealth you'll create and the cash flow you'll create. Recessions offer a limited opportunity to get clued up and implement rinse, repeat before the boom happens, because it will happen very, very soon. Well, in a few years' time. Get educated on all this stuff. Learn it, because from January onwards, it's starting to happen now. We're seeing all the signs. If you look at the auctions, auctions are the barometer of what happens in the property market. What happens there happens in the rest of the market in a few months' time. So we're already seeing all the signs of everything I'm talking about. Now's the time to get educated, get clued up on all of this stuff. January onwards is the time to start looking for these opportunities and putting these sort of deals together. I run the UK's leading commercial property training program. It's an 8-week program on how to do just this. So it's how to identify commercial property projects that are suitable for conversion to residential use, how to use these permitted development rights. It's an 8-week course. It's online. The modules are online, but every week we do a group coaching call where you bring sort of live deals to me and we go through them and answer questions that you have. It's the only commercial property training accredited by the Property Investors Bureau. On the back of your passes, there's a QR code where you can just scan all the information on this 8-week course to find out more. We also do a Mastermind program where people that really want to do this come and work together. One thing I find that is very, very useful, it's essential, is to work closely with like-minded people and surround yourself with people that are doing this stuff daily, day in, day out. Because in recessions, there's a lot of bad news around, and you've got to be careful who you listen to. You've got to make sure that you don't listen to people who aren't doing this stuff, that you listen to people that are doing this stuff. Because obviously, people who are doing this stuff know it and can help you and guide you. A little aside I wanted to share with you, actually. Obviously, a couple of days ago, Rishi Sunak became the PM of the UK. Now, I went to school in the 1980s, and in the 1980s, I was in all sorts of politics societies and debating societies and all of that, and I kind of fancied a career in politics and being an MP and all of that. But when I was at school and in my early 20s, people would tell me that there's no point. You know, you wouldn't get very far. You know, we're not ready for brown people to get high up in politics and everything like that. And I didn't pursue it. You know, and it made me think, you know, if you surround yourself with people telling you, no, that can't be done, guess what? You're not going to get anything done. It's as simple as that. Now, we live in a wonderful country where anything is possible. Anything is possible if you actually put your mind to it, you're clued up, and you actually take some action. You know? Recessions are a time where fortunes are made if you're clued up, and if you're surrounding yourself with the right people who are actually doing it and living and breathing it, and you're getting information from them to spur you along.
You live in the USA.
I do live in the
You're over
USA.
here on business.
Yes, I am.
And you've made a special trip to come here to the Baker Street property.
The quality of people here is better than quite a lot of the other meets.
Come all the way from California, and one of the reasons why I'm here, to meet like-minded people, other investors, build my network, and continue learning and growing in the property industry.
I found it's quite informative, and I can meet a lot of amazing people, so I keep coming.
Great knowledge in a great environment with like-minded individuals.